Moving on to Project 5. Project 5 covered the stock valuation. So to start, we'll cover the dividend discount model. Currently, Harley has a dividend yield of 3.56%. The industry dividend yield is 2.2%. Our main competitor, Polaris, has a dividend yield of 2.4%. Harley is the industry leader in returns on dividends, remaining far ahead of the rest of the industry. Over the past 5 years, Harley has seen variable growth. Between 2016 and 2017, there was a 4.28% increase. Prior to that, the growth rate was 12.9%, 12.7%, and 30.9%. As per Guru Focus, Harley currently has a growth rate of 9.9%. Harley follows the non-constant dividend growth model. Varying growth year to year, the dividend seems to be reliant on a previous revenue generation and is deemed worthy for a dividend at that current time. The cost of equity and the required rate of return is currently 11.7%. Using the dividend discount model of the next year's dividend over required rate of return minus growth, we came to a price of 82.22. Moving on to the PE multiple. PE ratio is a market price over earnings per share. Harley's seen a PE ratio below the S&P 500 in the past 5 years, indicating there could be some undervaluation of the stock based on earnings. In 2009, the PE ratio skyrocketed, which can be attributed to earnings as a result of the stock market crash. Relative to the industry, Harley has a low PE to the industry average, which is currently 14.8. Harley's PE currently is 12.3 for the trailing 12 months. To calculate price during our PE valuation, we use the forward PE provided by Yahoo Finance of 11.38 and the average EPS estimate of 3.76 to get a future stock price of $42.79. Using a high side EPS estimate of $4.23, we came with an upside price target of $48.14. Moving on to the price of sales multiple, Hog saw a rise in price of sales until 2013, where it was 1 point above the S&P 500. Following 2014, the PS ratio has been below average and diminishing down to its current rate of 1.2. This means either the price has fallen, the RPS has gone up, or a combination of both. This further analysis into the industry is needed to determine overvaluation or undervaluation. Hog currently has a price to sales ratio of 1.2, which is above the industry average of 0.8. This could signify some overvaluation based on revenue per share. So for our price to sales valuation, we used RPS of 31.2 times the price to sales multiple to come up with a future price of 37.44. The upside target I came up with was $39, which was based off an RPS high estimate of 32.5. In summary, the dividend discount model was an outlying result. With the price to sales and PE ratio, the average stock price has a valuation of 40.12. Currently, the stock is undervalued at $39.45, although last week it was trading above value at around $43. Stock is currently undervalued due to a negative market sentiment. Harley's seen earnings decreases in the past fiscal year. Although the stock is hanging on to some values through its dividend rate, the earnings and revenue decreases have shifted investor sentiment away from buying the stock. So we thought that this could lead to an opportunity for share repurchases. Harley can finance the program through their free cash flow that the company is currently sitting on. This would be a valuable opportunity to increase the earnings per share and create a more positive sentiment in the market to find earnings from the stock. Thank you.